Hello dear viewers, welcome to this video. In this video, I will give you introduction about financial modeling. In the upcoming videos, we will practically see how to prepare a financial model. Now let's see some of the financial uh, model definitions, purposes, and types of financial model. Coming to the definitions, we can define a financial model as a tool used to forecast a future business financial performance using Microsoft Excel sheet. We work on Microsoft Excel sheet mainly, and we prepare this tool, this model, to forecast a future business financial performance. Coming to the definition of financial modeling is a process of estimating the financial performance of a project or a company by considering all important factors that includes the historical growth rate, historical figures, maybe the historical properties, revenues, cost of goods sold, and we also consider other assumptions, risk assumptions, and we interpret their impact on future business performance. And then we come up with a financial model. That process is called a financial model. We base on the historical data, which is very important and a starting point for our financial modeling. Let's see some of the purposes of using a financial model. We use a financial model to raise capital, either to go for debt or equity. We need input through a financial modeling, and also to make acquisition and merger decision. We need a financial model that can show us the pros and cons of going for acquisition or merger. Also, to grow our business organically, that may be opening new stores, developing new products, entering into new markets, we need to go for a financial modeling process, and we need a strong financial model that shows us the the cash flows, the properties that we are going to generate from each product or each market that we are entering into. The other important purpose of using a financial model is to sell out our assets or to go for a divestment decision. That may be divesting assets or business units. We need a financial model. Also for budgeting and forecasting, like planning for like 5 years, 10 years, a financial model gives us or shows us roadmap for what we are going to do in the years ahead. Also to make a capital allocation by prioritizing projects. If we have like 3 projects, 4 projects, and if we need to prioritize them, we need to go for the financial modeling to prioritize the projects based on their feasibility and the future potential of income generation. And the other most important purpose of applying financial modeling is for company valuation and asset valuation or stock valuation. So for these two purposes, we also apply financial modeling. The other one is financial statement analysis, and for managerial accounting and decision, we need we need to know and we need to apply financial model of different types. We have seen the definition, we have seen the purposes, and now let's see the types of financial model. There are so many types of financial model based on the purposes. Here we have the first one is the three statement model. From the name itself, you can understand that this model is a structure of all the three financial statements that include income statement, balance sheet, and cash flow statement. And we interlink these three statements together, and then we project the future financial performance of a company in three statement model. The other important financial model is discounted cash flow model. As the name itself suggests that we consider discounted um, cash flow, discounted cash flow of the sum of the future cash flows. that a company is going to generate. We have seen some example in our previous video of my video series, but we will again discuss about this model in detail. And the other type of financial model we have here is budget model, uh, merger acquisition model, initial public offering model. This initial public offering model is mainly when a company issues new shares and starts selling in the market to the public. uh, this kind of model is important. The other one is leveraged buyout model. This is mainly used when a company acquires other companies by using borrowed money or debt to meet the acquisition costs. So what we see from here is that the cash flows from the assets and operations of the acquired company are used to pay off the debt and its charges. So we have to make sure that the money that is going to generate from the operations of the acquired company is um, sufficient to cover the costs or to pay off the charges. So to do that, we need a financial model of this type. And the other one is sum of the parties model. The name itself suggests this. You can easily understand that we have when a company is like conglomerate company having different segments or different business groups. What we do is we do a separate financial model for each part, and then we calculate the sum of the parts, the sum of all the segments, and that's why the name sum of the parts model is derived. The other important model for global business, for global companies, is consolidation model. When a company has multiple affiliations, I mean several subsidiaries, a company may go for this kind of a model, which is consolidation model. The last one here in this list is a comparative company analysis model. If you want to really identify or figure out how your company is performing against others industries, other companies in the same industry, you take the similar companies' financial performance and you do a kind of comparative company analysis. That is called comparative company analysis financial model. So I just try to collect mainly used financial model, but there are still many more financial models that are developed and applied in different business for different business purposes. So this is what I have for now. In the upcoming videos, we will start looking into three-step model. So keep tuned. Thank you for your time. See you with the next video. Bye bye.